So to explain what's going on here are the two illustrations we showed when gold was still under 4,000 and silver was still under 48. Now, as you can see, we were questioning why was it that the $17,000 carry cost to borrow a single 100-ounce COMEX gold contract, which was worth at the time 280,000, why had it not risen when gold was trading at 390,000? And then also the $16,000 cost to carry a 5,000-ounce silver contract, and that was at the time valued at 165,000. Well, why hadn't it risen when silver was trading 237,000? And they, of course, have risen since. Now, the reason was because the CME LBMA cartel alliance, which is, as we've talked about multiple times over the year, the London Precious Metals Clearing, LPMCL.
Global precious metal markets have historically been centered in London. In recent months, Andrew Maguire has been adamant. Silver market control has shifted from the London Bullion Market Association, LBMA. Physical scarcity and shifting global flows are overwhelming the centuries-old system of leasing, unallocated accounts, and synthetic exposures, he claims. He believes the regime is losing control over silver manipulation through paper contracts and derivatives. Maguire emphasizes China's role in this change. London's significance has declined due to the emergence of physically settled exchanges in Shanghai and other Asian hubs and supply chain shifts. It alters silver valuation, holding, and trading. A new axis challenges the conventional paradigm of London lease rates, unallocated silver credits, and back-office arbitrage as silver market plumbing. Maguire believes silver is approaching its physical value as this control erodes. He stresses that the market goes beyond paper futures and ledger entries. The outdated system cannot ignore real-time metal hoarding, demand, and delivery. For intelligent investors, this is a turning point that calls into question precious metal investing conventions. Your silver market knowledge may be outdated. What does this signify for 2025 and beyond? Maguire believes precious metals' tremendous run is just the beginning. With London's grip loosening, physical demand rising, supply chain limitations tightening, and new global hubs gaining power, silver and gold are poised for a far more explosive phase. Investors who comprehend structural change may be ready for the future. Stay with me through this study, since the next shift may change precious metal investing. Prior to Maguire's extensive analysis of lease rates, futures, spot spreads, and bank positions, please subscribe and ring the bell to catch the second half of this interview.
15th today that we're recording this. And we're going to follow, that way we can follow the footprints, and it makes more sense when you can follow those footprints. So let's take a quick look at the charts. To quickly recap, gold began trading on the fourth quarter trading at our end of third quarter 38.50 staging point here, and silver ended up consolidating at its 46.50 staging point, and obviously we're looking to follow these footprints. Now this represents the first 2 weeks of the fourth quarter in October in silver, and the same in gold. And following these 2 solid weeks of gains in both gold and silver, there's been several expected attempts to rein the rallies in both gold and silver, which have really wrong-footed the unallocated Loco-London cartel. Now, this was particularly evident, actually, in silver. In fact, the bulk of our questions revolve around silver, and we'll spend a good deal of time answering them shortly. However, spoiler alert, every attempt to synthetically cap prices, and this is why we're looking at the futures charts right now, each of these attempts have been completely siloed inside the cash-settled CME exchanges, and really has been limited to target the naked long speculators who coattail each fresh leg of very real, physically driven rallies. Exactly the same situation in gold, and each time that there has been an attempt, it has been shallow. And as we assessed in our last episode, each of these sell attempts exposed the LBMA CME COMEX as broken price takers. And with very few remaining real money traders still trusting the COMEX, it severely limited the ability to generate sufficient downside sell ignition that really could cause any lasting damage to what is a physically driven rally. Now, while we see the same in gold, silver always provides a better view of the footprints. Now, the first real attempt for this month occurred into what was actually a coordinated margin borrowing cost. Margins just means borrowing cost to borrow COMEX positions, whether it's silver or gold. And there was an announcement, which by no coincidence was timed with Powell's speech, and that was on the 9th, with saying that the cost to borrow these positions for COMEX gold and silver would rise the next day on the 10th. Now, whereas as we demonstrated in our last episode, the reason for the House delaying raising margins was to protect very large wrong-footed naked short commercials that's being called for delivery in China, but also that was to meet a large influx of Western ETF demand. We saw exactly the same thing in gold, which better represents the ETF demand. However, trapped between calls for bullion that they didn't have, and that by the 9th of October, just enough naked longs had got on board, speculators who had borrowed gold and silver from the house had got on board, it was deemed to be an optimum point to spring higher borrowing costs on this extremely leveraged group of naked long traders. And we're recording this on Wednesday, the 15th. So following this attempt, following another attempt yesterday on Tuesday, following another attempt today, essentially these rigged pit manager bid pulled events, and that's what it is. They're bid pulling. They know where the stops are, but there's very, very few speculators. There's very little real money involved, and it's really down to how many speculators can they rinse out on the way up. So these bid pull events are both necessary and constructive, serving to rinse out the low-hanging spec froth which has really coattailed the latest bout of upside momentum in silver and in gold. So to explain what's going on here are the two illustrations we showed when gold was still under 4,000 and silver was still under 48. Now, as you can see, we were questioning why was it that the $17,000 carry cost to borrow a single 100-ounce COMEX gold contract, which was worth at the time $280,000, why had it not risen when gold was trading at $390,000? And then also the $16,000 cost to carry a 5,000-ounce silver contract, and that was at the time valued at $165,000. Well, why hadn't it risen when silver was trading $237,000? And they, of course, have risen since. Now, the reason was because the CME LBMA cartel alliance, which is, as we've talked about multiple times over the year, the London Precious Metals Clearing, LPM and LPMCL, which are the four clearing banks that we've gone over year after year, that we've tracked since their formation, actually since April 2001. These guys, this cartel was on the wrong side of very, very large unallocated short positions. When we say unallocated, we're not talking, they're not one-to-one backed. And these positions were actually being used to report as hedging an equal number of, get this, asymmetric, imbalanced COMEX gold and silver position. So you've got an unpacked futures foreign exchange position balancing or supposedly hedging a totally imbalanced COMEX gold and silver position. So these are the banks that were basically settling stuff on their own books and then really just having to buy physical when it was absolutely necessary. Now, following a large forced short covering move, now if you recall the Bank of International Settlements having to square shorts at the end of the third quarter, the Fed having to square those BIS borrowings at the end of the third quarter. If you remember, we looked at it. They had to cover them $409 an ounce higher than they had sold it for in the attempts to cap gold, and they were wrong-footed. And that did expose the next 30 tons that they are still outstanding. Were at that point was going to cost them $4 billion in losses. That's a heck of a lot more now that gold has risen significantly since we illustrated this. Now, the CME finally raised their gold and silver margins, respectively, from 17,000 to 18,000, and in silver from 16 to 17,500. However, the good thing is, other than a dwindling number of speculators, there are very few real money takers.
Maguire meticulously describes how the London silver complex has collapsed in his first major interview. He cites lease rates of 24% and sometimes 30% to borrow silver in London and futures to spot spreads on the Chicago Mercantile Exchange CME or COMC structure that reached $15,000 per transaction, a clear sign that the paper universe is disconnected from metal flows. Maguire says these events lead to the bold claim that London has lost silver market dominance. Three meanings emerge from this. First, high silver borrow rates indicate substantial hoarding or constrained supply, since silver holders are unwilling to lend it out. Second, arbitrage is conceivable when paper futures are much cheaper than spot physical. Deliveries are slow, implying bottlenecks or structural barriers. Third, and most significantly, when London cannot marshal metal on demand, power goes to Asia, where metal is. Maguire prepares for his next point. Silver was never classified as a high-quality liquid asset. HQLA, like gold, was under Basel III. Thus, the unallocated and synthetic silver market grew unregulated. That means physically settled exchanges in China and other Asian markets are pressuring excessively leveraged positions, nominal vault credits, and paper claims in real time. According to Maguire, the outdated model has been replaced.
Spreads, in other words, the spread between the deeply undervalued COMEX futures markets and the much higher priced spot deliverable markets, further exposes COMEX silver is now acting as a price taker and is most definitely being targeted for another backdoor loadout. Now, by last Friday's London Open, lease rates to borrow silver to meet immediate delivery demand spiked way north of 24%. We're using 24%, but it was actually over 30%, driving the silver short squeeze EFP basis spreads that we just talked about. And here we captured it here live at a huge $2.80. That's $14,000 per contract difference. In fact, it has been as high as $3 or $15,000 per contract. Now, the expanded basis spread misplaces the spot equivalent fix. So to illustrate, we spot adjust it in and demonstrate it in green at the fix hours. And as you can see, it is substantially higher than the COMEX, where we actually place the equivalent COMEX fix. At the peak, we captured these unprecedented futures backwardations extending all the way through to July 2028. This is mind-boggling. It's unprecedented. illustrated mispricing COMEX silver market futures are completely broken. The market's broken. Whereas in real time, we're evidencing the SGE-centric physically settled global spot markets shaking this COMEX tail. It's amazing to me that how few people have actually woken up to this huge breaking of the COMEX. In fact, the SGEI silver prices are setting local London spot prices, consistently one-to-one mirroring the fresh highs in spot silver as well as gold. So now, Shane, I'm going to move to answer the bulk of all the questions. Why the lower priced CME LBMA exchange for physical basis spreads have been so slow to close. I mean, you're talking about 14, 15,000. Well, why the heck would you just not take that silver and dump it into London and take the profit? Why has it been so slow to close? And in short, the unprecedented supply constraints, there is hoarding alongside strategic positioning around critical minerals leading to global export controls, have left London silver cupboards absolutely bare. Now, worse, unallocated, undeliverable local London FX obligations that had been so-called hedging these COMEX short positions. So when they're called on for physical delivery, these bets in London, these bets are impossible to cover into globally driven, higher physical priced demand. And what it's done is exposed these asymmetrically mismatched LBMA CME derivative bets as naked. Now, these bets are being called in. That's what's happening, threatening default if they're not brought back at higher prices, further tightening supply. Now, these global physical shortages have spilled out into all global exchanges, as exampled by India's Kotak Mahindra haltering ETF investments, as noted here. They were citing a lack of supply at current prices. Since then, UTI, SBI mutual funds, and one others have effectively immediately now suspended fresh subscriptions to their silver ETF fund or funds. You cannot get access to it. London has lost control of the global silver market. We said it last time. It is now so clear it's hard to ignore. Unprecedentedly high risk, unfulfilled local London lease fees illustrate both a lack of trust to lend metal into global supply tightness. So, why you can't trust it? It's too risky. These spreads could be closed at any time.
Future ramifications for precious metals are significant. If Maguire is right and London's traditional system is being bypassed, silver and gold will gravitate toward physical settlement hubs. Western exchanges must adjust or risk irrelevance as Asia, particularly China, sets prices. The message is apparent to investors. Paper positions without real metal no longer guarantee liquidity and pricing symmetry. Another factor is supply limits. Maguire stresses that global physical silver shortages are real. They appear in London inventory declines, export prohibitions, and Asian delivery demands. The Silver Institute reports that annual demand has surpassed supply by hundreds of millions of ounces for several years. Industrial demand for solar panels, electronics, and sustainable energy infrastructure compounds scarcity. As physical flows tighten and synthetic claims fail, pricing models must change. For investors, the legacy gold-silver ratio, the idea that silver is worth less than gold, may be changing. Maguire suggests that silver's relative undervaluation and smaller, more volatile market make it more susceptible to a breakout when structural linkages to London fade. Major banks report that London is in seizure with silver lease rates and backwardation rising. Urgency is there. Finally, Maguire's research recommends alertness, not inactivity, in investment strategy. This goes beyond trending, recognizing that precious metal investing rules are changing. Recalculating allocations, counterparty risk, and physical holding vaults may be needed. The investor who realizes metal, not paper, is the standard may win in 2025 and beyond. Thanks for watching. If you liked my analysis, please like the video, share it with investors, and post questions below. Subscribe and hit the bell to get updates on new videos. See you next video. Thanks for watching.